So you want to know what's going on in the market today? Well, stay tuned. We've got an industry update coming up next. Well, welcome back. We are here once again on NoteSchool TV, just like we are every single Wednesday at 11:05 Central Time. So make sure you're joining us. We have an incredible show coming up this week, and I'm hoping that this is just more value coming across the screen for you, because as always, this is our objective. So if what you hear today is awesome, you really think it's going to be good content that helps your business, man, we'd love it if you'd like the video. Just simply go and click that button to like this video. This really helps us tailor the content on what we should be bringing to you throughout the year. And in that same vein, right, we'd love for you to go to the YouTube channel and simply subscribe to the channel. That way, when we're putting out other content outside of NoteSchool TV, because we're trying to push out lots of content every single week, you can get that into your YouTube feed and you can be in the know like we are. And probably the most important one specifically for NoteSchool TV is there is a little bell right there on YouTube. And if you'll go and you click that bell button, it will actually notify you on your device. It'll literally send an alert like to your cell phone saying, hey, NoteSchool's going live in 30 minutes. Jump on. This gives you an opportunity to participate in the show, engage in conversation and comment, so that we can get those questions answered and help you take that next step towards building your wealth. Well, normally we would have some really interesting news articles, but we are actually going to forego that because this week's show is all about the industry update and really what's going on and what you need to know right now in today's marketplace. And so without waiting any farther, let me bring on my good friends, my mentors, Mr. Joe and Eddie.
Well, good morning, Brian. How are you, sir?
I'm good, Mr. Speed. How are you?
I'm great, guys. How are you?
Fantastic, fantastic. So you've got, I've already heard about the number of hours you've poured into this research. And so you've got quite the industry update. Is that correct today?
You know, it's not just me, but there's several people that are involved in helping us scrape this data. And one of them is Joe, and thank you for that, Joe. Mm-hmm. But yeah, we've got a lot of research time in this, and we think we've pulled together the most relevant things to cover of where we've been in the market for the last month and why it's relevant to you.
That's right. And Eddie, you know, what we're focused on here in the mission is that, you know, is to understand how these stats point us to the voids in the marketplace. For instance, burnout landlords, right? Non-performing loans. And, you know, that's what we're focused on at NoteSchool right now. And that's those are the voids that everybody needs to be focused on to build their business, right?
No doubt about it. It's not just knowing the data, but it's knowing what the data is going to tell you. So that's a pretty significant thing. So let's get started.
Yeah.
Joe, to start out, housing market black swan bubbling. That's kind of disturbing a little bit.
Yeah, that whole bubbling thing does kind of throw up, well, a little bit of a kind of a crazy image, right?
Yeah.
But here's the process. We are, you know, one of the reasons that the market is on fire, right, is because of the lack of inventory. And what this article really is talking about is the building, you know, the building industry. And there's 689,000 single family homes under construction right now. But again, this is going to continue. The prices will not adjust down or will not change until the inventory catches up with the supply, the whole supply and demand, basic economics, right? So that's really where we're going with this is once we have the inventory, then we'll see some of that equilibrium reach there.
Yeah. So Joe, let's talk about this. We're really in a record year, right? Yeah. 16% growth year over year, 16.6. Yeah. And wow, 38% above where we were in 2006, 38%.
And that peak in 2006, in March of 2006, was significant in itself, right? And that's back when anybody could qualify for a loan, right?
Well, if you look at this chart right here, you can pretty much see the increase in building activity. That's a pretty notable line there, Joe.
Looks to be about as straight up as you can get. That's going.
Going in the upward direction. Is that what you're saying?
That's right. Yeah, that's the throttle to the wall and got the nose of the jet straight up. There you go.
That's it. All right. So Joe, big deal here. We have made a huge focus in the direction, not only in our company and the activities that we have in our company. Mm-hmm. I know that Joe, you've done independently. You are driving a campaign based on the stress of landlords.
Right.
And why that's true is relative to the data that we're going to show you. If a landlord has stress, Joe, then that shows me there's an opportunity for me if I know how to solve a problem, right? Well, so let's talk about what some of those things mean. But let's talk about the federal side first, Joe.
Well, you followed NoteSchool TV for the last several months. We've been talking about this, this moratorium on the evictions, and it's gone back and forth, right? The Centers for Disease Control said, yes, you could do the moratoriums, and the courts got involved and said no. But right now, just as of last Friday, federal judges dismissed the latest challenge. So the moratorium does hold until October 3rd, which just, again, the landlords had thought they had seen some of the light at the end of the tunnel, but boom, it gets extended again for another, 2 months. So the stress there, Eddie, and you and I talk about this a lot. The real estate market has been very good as far as the appreciation of these single family homes. And by the way, we're talking about these stats, this SFR here, single family residential renters. This is the small landlords, right? This is single family homes, not apartment buildings and all of that. That is inventory owned by the small landlord, classified as being, less than 5 units. So they own 3 single family homes and maybe a duplex or whatever that looks like. But the rental, so the appreciation has been great, but the tenants have not been so great based on the pandemic and the non-collection of rent. 15 million single family residential renters owe more than $20 billion. That's a pile of money.
Crazy. Yeah. So what this is relevant to, guys, is everybody can see what's great about the market, but who's bleeding in the market and can I solve a problem?
Right.
Yeah. As you said, Joe, the market's been kind to them. The appreciation in value has been kind. The not getting paid by the tenants has not been kind. 50% of tenants have missed rent. 50%.
Half. Yeah.
Wow. 58% of small landlords are owed back rent. 58% small landlords. Now, we generally call these landlords, the market calls them 5 houses or less is what they owe, right?
Right.
So this says that this problem hasn't been solved.
Yeah. Well, 3 out of 5 are not receiving rent, and that puts a hardship, Eddie. These guys are right at the end of their ropes, right?
Once again, it's a market condition, right? If you're trying to buy real estate, you understand where it is. And just to get a sense of this government assistance program that came in, well, Joe, there was $47 billion available. That's awesome, right?
That's great.
But $3 billion has been deployed to date.
That's it. I mean, that, and by the way, these stats, guys, are the latest stats. I mean, you can see this is from August 22nd up here, but this is through the end of July because everything is 30. But that's what it is. It hasn't gone up much in the distribution of those funds that are available for stressed out landlords.
Wonder if they bought any new furniture for those offices that were in
charge. I'm not even going to go there, right?
Just curious.
I know.
All right. So, and so, Joe, this is a pretty strong statement here. Small landlords are saying they want to sell. Talk about this article a little bit and kind of surmise what it said about that.
Well, Eddie, when folks bought a rental property or 2 or 3 houses, right, they wanted passive income. That's really what they wanted. They didn't necessarily want to manage properties and do that, but we have a lot of things to say about what that landlord looks like. But we know that with them being frustrated, we can show them, being in the creative finance business, we call it buying and selling on terms, right? We can go in and we can put a deal together so that we can give them what they truly wanted, right? Which is passive income. They wanted passive income, and they become the bank. And then we get in the middle of that by buying it from them on terms and then reselling it to what we call a burnout or a penalty box buyer, right?
Yeah. So they lacked cash flow because the tenant wasn't paying. By the way, half of these people didn't have a mortgage,
right?
Statistics say.
And
the market has been really kind to them. So the property's gone up in value. So they have equity. Joe, there is a tax strategy where they could defer paying taxes over a long period of time.
Right.
That creative finance people understand, and most small-time landlords would never think of it.
That's right.
Big opportunity there, Joe.
Well, and Eddie, we're not saying that you are not going to pay the taxes, right? We're saying that you're going to defer and pay those over time based on the IRS calling this an installment sale, right? And you're right. We do have a lot to say about that. And that's one of our focuses right now, because we know we have a pretty good idea. We don't know, but we have a pretty good idea that the tax situation for capital gains is going to change here in a few months, specifically around the 1st of next year.
Yeah, whether a landlord is affected by a tax increase or not, when you're going to be taxed based on the year you sold it, even if you pay that out over time, right? Installment sales basis. Right. So it's a big deal and a big opportunity. So the burnout landlord is, I just exchanged a text this morning with a number 2 guy of a major marketer in the real estate investor space. I'm sure they run marketing for probably 25 or 30% of many of the top 500 real estate investors. Right. And I identified this customer and this pain and this solution as one of the biggest opportunities I see in the market. Oh, yeah. So we're big on this. We're teaching this a lot. We're implementing it in our businesses. And so we think this is an opportunity. So understand that you got to know some data sometimes to know where the void in the market is. So right. Joe, let's move on. The Mortgage Monitor, Black Knight has done a killer good job of producing a monthly report. And we have used this several times because it has such good data. And so we're going to look through here. So Joe, just kind of summarize what we're going to talk about today here.
Well, what we see that, as far as June goes, and this is the latest data, right? This is the latest data. The delinquency rate, continues to go down, and it's down 7.6%. Doesn't mean it's gone away, because it was way up here, and it's gone down just a bit, but that's fine. That's fine in the marketplace, because we want to see that. But there are still, well, if you look at the serious delinquencies, but there is still, Eddie, a big pile of those, and we'll look at those as we move through the presentation here, through the update here. And then, some of these prepayment rates are going up as well. So those stats overall, they look pretty good, but it doesn't tell the complete story. And this is another market void, right? We talk about NPLs, non-performing loans, and the opportunities that we are going to see moving forward.
Very good. And they've done a good job. I think they're calling it right down the middle. They're not hopping the numbers up.
Right.
It's just good data. They're not trying to position the market anything, saying we are positioning the market based on their report.
Right.
Right. That's what we're doing. We didn't need to do the research. They did great research. We're trying to take their research and saying, okay, with that, let's put our binoculars on and look out over the horizon and see where the opportunity is. So right. Great point. So Joe, I know this is, and by the way, these slides are available to you guys, and we're going to have them as a download. So you're going to be able to get this slide deck so that you can look at them later. So Joe, on the left here, what we're pretty much seeing is the delinquency rate on first mortgages.
Right.
And this goes back.
Well, it goes back to 2001.
Yeah, that's pretty incredible. So the delinquency rate is the dark blue line.
Correct.
Okay, so we saw it shoot up during the virus,
right?
But see, Joe, it looks like it's not that bad, right? It's 4.3%. Now that does not include loans in forbearance, correct, Joe?
Correct. That is correct. So what we know, Eddie, right now is there's about 2.6 million loans that are 90 days or more delinquent. We call those the seriously delinquent loans, right?
Yeah.
And then there's still about 1.861 million loans that are in forbearance. And we'll talk a little more about that as we go through this. But guys, if you'll notice that, it was way down back in, if that's 12 of 2019, which is the fourth one over on the bottom, and you see that by June of 2020, which is the second one over from the right, wow, look at that. It just shoots straight up, right? Goes to 8%.
Yeah. So the on the chart on the right here, it really shows, this shows the delinquency, and this is seriously delinquent loans.
That's right.
And look at this trend, Joe.
That's it.
Now, look, let's do a little drawing around this, okay? Because this is kind of relevant, because this is what we pay attention to. This, Joe, was this number here, which we really think is always the 90+ days delinquent.
The dark blue line, correct.
And if you look at it at the peak of the problem, Joe, let's call it in here.
Right.
Okay.
That was midsummer last year.
Midsummer last year. And here we are today, correct?
That's right.
Now, Joe, and I hope I drew a straight enough line, because I wasn't trying to hop the number. Joe, that is not a huge decrease.
No, it's not.
Now the others, I'm going to use a different color here and highlighting. The others are pretty dramatically dropped, right? And that's awesome. Look at this one. This number's dramatically changed. So let me grab that slide back.
Yeah, that was the 30-day.
A lot of things going on here, Joe. You know what I'm saying?
Yeah, I know, right? I'm glad you're running that and not me.
So this number is down, right? And that's 30 days delinquent. And then here's 60 days delinquent. I know I'm kind of drawing over it, but you get the point.
Yeah, we get the picture. Yeah.
And so that's good.
Right.
But what we're paying attention to is it's not all good. Because the truth of the matter is, Joe, the seriously delinquent, that number is not sliding down much.
No, it's not come down significantly at all.
And all right, so Joe, we have some 1.86 million active forbearance plans. So call it just under 1,900,000 loans that are currently in forbearance.
That's correct.
Okay. What we've been monitoring and what we think is a really big deal, guys, is the expiration of when they go out of their plan. Right?
That's correct.
So, Joe, I'm going to sort of draw a circle around these highest months. And as you can see, they've just happened, or they are just going to happen. Now, by the way, there's some very specific federal limitations on how long a forbearance plan can last. So we can say, well, the government's just going to take all these loans back in there and do forbearance again. That's not really the case. It's not just the president signed an executive order on this, right, Joe?
That's right.
So the bottom line is, if you look at this right here, we have a lot of forbearance assets that are right at the cusp of coming due.
Well, yeah. So if there's 1.861 million, Eddie, and we've got, what is that? About 680,000 of those plans that will expire. So that's more than a third of the plans that will expire in September. And then you've got another, what is that? About 320,000, let's call it, that will expire in October. So about half of the forbearance plans will expire within the next, 60 days?
And the issue, Joe, by the way, is the biggest thing out there is FHA is 3 times the percentage of delinquency of Fannie Freddie.
Yep, FHA and VA is significant. Yeah.
Right. So this is a big deal, right? This is FHA, VA now making up over 40% of all the loans in forbearance. Well, they're not 40% of the number of loans being made. So they're outpacing the Fannie Freddie loans by a lot.
Right.
All right. So Joe, this is a somewhat of a similar graph, but this paints a pretty good picture. And you did a great job of scraping this out of the Black Knight report. Good job, Black Knight.
Yeah, absolutely. Thank you.
And that is, it sort of shows us the peak of the market here, Joe.
Right.
And it's what we're saying. There's a lot of loans that are fixing to come up for the end of their forbearance. And Joe, they're going to be forced to do something. They haven't been forced to do something, but they're going to be forced to do something.
Yeah.
And this is a lot of assets, right? This is, call this area in here, Joe, this is going to be way north of 1 million loans.
That's right, Eddie. North of 1 million loans, and they've got to be either, if they're going to modify, then they've got to qualify for that modification, right? And
yeah, and so don't automatically assume all these loans are going to get extended and roll forward.
Right.
Okay, I like this chart, Joe, because this is just a good summary of what we've done in the last couple.
Right.
The one in green up here, these are loans that are now they're back paying again, or they're not in forbearance.
That's correct. There was 7.3 million forbearances, and then those have exited, right? They've expired or they've been removed. So that's about half, 3.461 million.
Okay. The gray, which is what we have been saying all along, the gray represents loans that have been paid off.
That's right.
That, Joe, what that probably represents is people looked up and said, hey, we got a heck of a lot of equity in the property, and let's pay our dadgum loan off. And that way we're not in forbearance anymore.
That's right. We can sell it. We can move on with our lives, and then we can go back and play again later, right?
Right. Joe, the blue, however, is a pie chart of loans that are now still in forbearance. So I'm going to do my abbreviation here is a F/B, right? Forbearance.
And that's the 1.861 million loans right there. That's it.
And that would be something that we believe is going to drastically change the inventory of real estate available, the availability of non-performing notes, the availability of sub-2 takeover transactions. I mean, Joe, the people that are real estate investors that are familiar with these strategies, this is the biggest inventory we've seen since, call it 2012.
And Eddie, if we look at the numbers in totality, right, add that to the 2.6 or so million that are not in forbearance but are seriously delinquent, we've got about 4.461 million loans. Or if we look at the number, that's about 7% of there's about 53 million single family first mortgages in the system at any given time, right? And so that's about 7% of all the loans that are out there, which really that's a huge number. So, we've been talking about non-performing loans, and this is one of those market voids that, we're talking about. There's a huge opportunity there. And it's a little different than it was back during the Great Recession back in the 8, 9, 10, 11, and 12.
This is a story.
Yeah.
Okay. So, Joe, it isn't all bad.
No, it's not.
There's some killer good stuff. Guess what's happened to residential real estate values?
Yeah, they're on fire, as Bob Repass likes to say, right?
Look at the market. Look at the market here, Joe.
Yeah.
and
yeah, that was April of 20. Yep.
And look at the trend.
Yep.
And by the way, this was in earlier this year. Now, Joe, I live in a neighborhood that has a gigantic short. I live in a community that has a gigantic shortage of listings. So I wouldn't say they've experienced the slide that all of the national data has experienced. So you may live in a market, or your properties may be in a market that may not reflect this, but they have slid back down a little bit, Joe.
That's right. And Eddie, I mean, I think to put that into perspective, we're looking at, that drop there between the top there in April of this year and where we are now. Those prices were up 25% year over year in June, and they've just leveled out a little bit, right? They're still up 17% over what they were last year.
So they were up 25%. And so that was kind of like the wild top of the market. Now there's still markets, as we said. I happen to live in an area that I know that it's still up like that, but not everything is. This is good stuff, and it just helps us kind of do. Joe, I love this as kind of a summary.
Yeah.
These are loans that are not in forbearance. Okay. So let's just go to the latest report. You guys know that by the time all these data information comes in, Joe, the 90 days delinquent, once again, we've seen the severity. That delinquency is not dropping very much. And you've seen the chart that shows that. There's 1.5 million loans, call it, of loans that are 90 days delinquent.
Right.
And there's another 145,000 in foreclosure. And Joe, we have recently just bought a bunch of loans that are in that foreclosure status.
Exactly. Yes, we have.
Right. So there's a lot of loans that are getting sold right now that are called legacy loans, that were delinquent before the virus. A lot to be said about that.
Pre-pandemic, right.
So Joe, here's about to call it 2.5 million loans right here that are delinquent, that are not in forbearance.
Correct.
So if you add the two together, this kind of shows you to how we're getting to the math, right? And over 4 million loans are going to fit in this category. So this is a big thing, right? Shadow inventory is a big thing. So Joe, I love this. What you call the blast from the past. What year was this?
That was 1984. I was going through some stuff with my dad the other day, and he pulled it out and he goes, "Look at this." And there was something on the other side of that, and he had just flipped it over, right? Yeah, 1984. Now, Eddie, what that doesn't reflect, because I did some research on this as well, is that inflation was at 12%, right? Mortgage interest rates were at 18 to 24%. So, yeah, there's always a give or take, right?
True story. I was deeply involved in the note business in 1984, and what's funny, Joe, when rates were so high and seller financing was so prevalent, we kind of missed a market opportunity. By the way, mortgage credit availability is still about the same that it was. Right. And basically call it about 35% of the people that couldn't get a mortgage before the virus can get one now. So the point, Joe, I believe, is overall, and that is, we've got a heck of a market opportunity, right? If we understand that we have a housing boom, a shortage of credit, which we've mentioned numerous times on this show, got all kind of data that shows that. We've got burnout landlords that really are motivated to go do something different, and maybe with a little tax angle, that becomes an incredible strategy they hadn't considered before. And then all of a sudden add to it the waterfall that we knew was going to come right down the mountain, which is the non-performing note place, which is buying non-performing notes. And we've talked about that on NoteSchool TV a whole lot in this past month. And then the other thing, of course, is the thing of taking over somebody's mortgage and helping them bring it current with a sub 2. So I don't know if there's any show that we've ever done, Joe, that is more newsworthy than now. because when we were discussing these things in the past, we were sort of looking pretty far down the mountain. Right. We were talking about things that were going to happen in late summer. And Joe, it happens to be late summer.
And Eddie, I'm going to throw one other thing out there, right? And that is the fact that there is more dry cash sitting in self-directed IRA accounts, sitting in money market accounts right now than there's ever been. So there's a lot of investors, private investors out there that are looking for a good investment.
They are not so worried about the yield as they're worried about return of their money.
Absolutely.
They're not so much return. They're not looking for a return as much as they are looking most for the return of their principal. Right. And then they're willing to accept a more modest yield. And why does that matter? Because a lot of our business is fueled. 100% of my business is really fueled by private investors,
right? Passive
private investors. And so people ask me, like what all is happening in the market and stuff. And yeah, there are, people are doing crazy things and paying crazy prices for real estate. But on the other side, there's a lot of money sitting on the sidelines that necessarily not everybody's doing that.
Right.
Right. So we hope today this has been relevant to really help you see that. Brian, hey, bud.
Hey, guys, I was trying to get a hold of that Harbor Federal for that 12% interest. They're not picking up. Yeah, I couldn't get them on the line, so I apologize.
SNL here in Okeechobee, my hometown, Okeechobee, Florida. Yeah, that's right.
That's awesome. Well, hey, listen, what you presented is not just fascinating. It really highlights this idea of a lot of times the market has pain and everybody sees the pain part. The question is, do you have a creative solution that you can bring to those complicated problems, not just to help and solve the market problems, but also as investors to profit and grow your own business and really ultimately build your wealth, right? And so part of the thing that really stood out to me, because I think how you kind of summarized it, really from the tenant not paying and the landlord just really struggling, all the way to there's this huge opportunity with notes and the fact that you can raise all this money because people are just sitting there thinking the market's not going to keep doing this for another 10 years. But you referenced something, I want to say it was like a year ago, that you said there's going to be this wall, and this wall is it's being held up of all these loans that aren't really doing anything, right? They're just being kind of held back by these programs. And there's going to come a day where that wall can't be held up anymore. Right. And I think after all this time of us saying in some of the classes that we've teach, some of you have attended one-day classes that we've talked about this. Now is actually the time where, look, that wall, it's about to come crumbling down. And the question becomes, are you prepared? Not just financially, because I think there's plenty of capital you can raise. The bigger one is, are you prepared here, right? Do you understand this? And if you don't, how can we help get you moving forward? And so I think the easiest segue is actually to step one. Let's talk about our sponsor, Notes Direct, and the Feeding Frenzy Friday. That's right. NoteSchool TV is sponsored by Notes Direct and the Feeding Frenzy Friday. And what that means is Notes Direct is simply a sister company that allows you to buy a note as easy as you would buy a pair of shoes on Amazon or some website, right? It allows you to simply get into the game when you're ready. And what we have is a whole nother playlist on our YouTube channel called the Feeding Frenzy Friday. And every single week, Scott Tyler, a veteran in the note business for almost 30 years, and we take a note off of Notes Direct and we kind of piece it apart so we can really help you better understand what it is, what you should be looking at, how to master that due diligence so you can gain that confidence, have the knowledge, and ultimately go out and take action to simply click that buy button and get into the note game. And so that is probably the easiest way to get into the game if you're wanting to. And as always, if you're somebody who says, I love that there's notes available, that's really cool. I love what you guys do on Feeding Frenzy Friday. Where can I learn more? I got to tell you, we've got a site you can go to right now. No matter where you are in your journey, if you're trying to figure out what is that next step for me, you can go to noteschool.com/TV to learn a little bit more. And that's just one of the ways. If you have this burning desire, like this question inside of you that like, I have to get this answered right now. Eddie's telling me there's a market. I need to get in. Man, just go to the noteschool.com website. And there's a little button at the top that says contact us. And when you click that, you can put in information. We've got some people who will happily reach out to you. We'll ask some questions and find out how we can help you get going on those next steps. And so, as always, this has been a fantastic show. I think this is probably one of my favorite shows we've done in, almost a year. It's been amazing. And so again, if this was valuable, which I know for me it was, so I'm going to go click that like button. Please go click that like button. Again, it really helps to drive what content we bring to the table. And then subscribe to the channel because, hey, that wall is coming down that we just talked about. You need to be in the know for you, your business, and maybe your family's business, right? And if this is content that you think is really worthy of sharing, there's a share button here that you can simply click share. You can grab a link. You can text that to people, email it to people. Continue to share the information so everyone's in the know. That way, we're all participating in the market together. We're all ultimately thriving in the opportunity that's been handed to us, and we're solving a lot of problems. And so for all of us here at NoteSchool TV, as always, it's great to see you. Thanks for joining us. We're going to be here next Wednesday, like we are every Wednesday at 11:05 Central Time. So make sure you're jumping on and have a great weekend. We'll plan on seeing everyone on the other side.